Hello, this is David Kelly. I'm Chief Strategist here at JP Morgan Asset Management. And I want to share some thoughts with you on the Fed's decision to leave the federal funds rate unchanged at its January meeting, and what the Fed's communications tell us about the direction of monetary policy from here. The decision to leave rates unchanged was widely anticipated, given solid economic growth, low unemployment rate, and inflation that is still running above the Fed's 2% target. However, changes made to the Fed statement reinforce the idea that they may not be in a hurry to cut rates further for some time. In particular, the Fed removed language acknowledging progress in getting inflation down to its 2% goal, while continuing to note that inflation remains somewhat elevated. They also removed text noting that the unemployment rate has moved up in recent months, replacing it with an assertion that the unemployment rate has stabilized at a low level. Chairman Powell, on many occasions, dodged reporter questions, asking him to comment on administration policies. However, he did acknowledge that there is significant uncertainty surrounding immigration, trade, deregulation, and fiscal policies and their impact on the economy. This uncertainty should diminish in the months ahead, and if inflation resumes its downward path, the Fed seems willing to resume its easing. However, for now, the Fed remains quietly on hold, hoping to maintain its traditional neutrality and independence relative to the political side of Washington. For investors, the economy remains on a positive and stable path, with a little significant change in monetary policy expected. However, given uncertainty around the macro effects of administration policies, high valuations, and the concentration of market gains in just a few stocks, this remains a good time to make sure that portfolios are appropriately and broadly diversified. Thank you for watching.